Well, the market making steady and slow progress each day. We've got some traders now pegging out 4,000 as a target moving forward. What's your view on the markets and where we're headed this week?
The outlook is impressive. The rally has actually been sustainable, making most of us analysts who are a bit pessimistic about its sustainability reevaluate our fundamentals, now actually looking at it. However, the 4,000 mark that many analysts and even the dealers at the NAC are saying that will be the top mark at the end of the month, or probably the coming month of February. I don't think it will be sustainable because the economic fundamentals of our economy are still weak. The promised government stimulus package into our economy in terms of infrastructure development, liquidity and foreign exchange reserves are still yet to be actually implemented. And you've seen mass exodus in key stocks like Safaricom, whereby the number of CDS account holders at the CDS have actually reduced by almost 500,000. So in terms of analysis, the fundamentals are good, but also we need to look at the underbelly of actually on how we can actually be able to sustain the current rally that we have.
Steve, in that context, then how are you playing the market at the moment?
Basically, we're trying to play the market in terms of looking at the fundamental aspect of it instead of the emotional aspect of it, the human sentiment. We've seen the rally in Kenya Commercial Bank, Equity, Mumias and Safaricom being pushed by human sentiment, because there have been many deals being cut by foreign investors. So we're looking at companies that have good fundamentals, markets that actually have new products and services in as far as the respective business is concerned into the market. This is how we're actually looking at it, and we're focusing most of our business investments through research work, so we can be able to tell how the next quarter is actually going to be, where we are coming from, and looking at the market key indicators.
Let's take a look at one of the stocks that you've highlighted there, Mumias Sugar. Looking at the fundamentals of that company, I mean, we know that we've got government planning to offload a 51% stake in 5 sugar companies to strategic investors and then give another 30% to farmers as well. How do you see that changing the playing field for Mumias Sugar specifically?
I believe it's a positive move for Mumias Sugar because one, it's interested in actually buying a couple of the said companies like Nzoya, Sony and Chemilil. Two, the strategy by the government is basically to bring in better management, enhance new equipment that can actually be able to enhance production and reduce costs. And basically, with the East African community integration actually becoming a reality, we need to look beyond just Kenya. Now we're looking at 5 countries that actually can be able to take in our products in terms of exports. So the government's strategy in streamlining the sugar industry is actually good, because what we've been lacking most in that specific industry is management, the aspect of research, and how policy is actually done to give incentives to farmers and get funding for them so that they keep growing this particular type of crop instead of going into subsistence farming.
How's Mumias Sugar getting it right, Steve, in a context where we've had critics say that high production costs on the one hand and then the lack of credit for farmers on the other is actually leading to low yields, stifling the industry as a whole? How is Mumias getting it right, and what's its investment merit at this stage?
Mumias has been able to diversify its products. This is apart from production of sugar. We've seen it's gone into the aspect of producing of biodiesel, biofuels. That's one. We've seen a production of electricity. It signed a very good and impressive contract with the generating company. So these 2 particular services have actually been able to sit through its bad moments as far as production of sugar is concerned. And then we've seen that its management has been above par. How its marketing strategy has been good. It's focused most of its products on research work, so it's been able to stay ahead of its peers in the industry. This is how Mumias has been able to actually get it right and stay ahead.
Let's take a look at KenGen because we know that this is, of course, the main power producer. It seems to be seeing improving investor sentiment after a slew of announcements for the firm's intention to enhance capacity and its expansion plans moving down the line. The company announcing a number of measures to actually boost that capacity. What's your view on KenGen at the moment?
KenGen is actually one key stock that many analysts have been ignoring, but when you look at the fundamentals, when you look at the government support and what it's been announcing in the last recent past, basically to enhance capacity, to ensure that its services and products are actually better, it's a stock that most of investors through research are actually looking at, because it's in essence it's a monopoly in terms of generating power. And it has gotten a lot of support from the government and foreign investors who are interested in infrastructure development in the energy sector, so that Kenya can actually have what you call a sustainable energy power outlet. So KenGen is a good stock to watch. The outlook is impressive, and we're hoping that it's basically its announcements at the NAC will actually go through in terms of its bond listing, and how the share will actually grow in terms of them being able to get more capital to fund their projects.
At the end of last week, another stock that stood in the spotlight was Access Kenya, the country's only publicly traded internet company, of course, and this despite its announcement that it expects profit to improve as the East African's fiber optic link helps boost the number of household connections in the region. So let's look at the reasons for the fallback that Access Kenya is experiencing despite the positive conditions and market environment it's operating in.
Access Kenya is actually in what you call at the cusp of a different revolutionary in this decade in Kenya, especially because many people have realized that the IT platform is what is going to be the vehicle for wealth creation, and how businesses are actually going to be able to conduct their affairs. Through this, people are going to reduce costs in terms of handling business, reduction of costs in terms of transactions and things like that. Access Kenya has actually taken advantage of looking at how people want to work. High-end connectivity is a key product for them, because research by Stedman Poll a while back indicated that many people prefer to work from home, as long as they have the internet connections. It's easier and they're able to produce more. So, and we've seen examples of how Facebook has actually been able to transform how internet is actually looked at. So Access Kenya, through research and its strategy in terms of the products and services, has been able to come up with a strategy that is able to get it in and enable it to stay ahead, that being able to buy a lot of data offering companies, so that it can be able to compete with a company like Safaricom, because Safaricom has a bigger infrastructure when you compare to Access Kenya. But Access Kenya really wants to focus on data connectivity.
Yeah, the company reported a 20% decrease in first half net income last year as costs rose and administration expenses advanced as well, even as sales grew 55%. We are expecting full year earnings to be released by March. What's your outlook in that regard?
In any investment like what Access Kenya has actually gone through, given the fact that they've been doing a lot of investment in the projects for fiber optics enhancement, in the infrastructure build-up before June this year. This is where we can say most of its money has actually been going through. So in terms of its reduction in profits and things like that, it's actually understandable, because they've done huge investments. But given the fact that now the investments are starting to pay off, and most players in the industry are yet to agree on the terms of rates and how to go forward, I think they'll be able to recoup. The profits will actually be able to go up at least 17%. And come the second quarter of this year, they should be back on one of the companies that will be looking at in terms of making profits and strong economic fundamentals.